I am Pawan Kumar, General Manager, Performance Planning and Review Department of the bank. On behalf of State Bank of India, I am delighted to welcome the analysts, investors, colleagues, and everyone present here today on the occasion of the declaration of the financial year 2025 results of the bank. I also extend a very warm welcome to all the people who are assessing the event through our live webcast. We have with us on the stage our Chairman, Sir, Shri C.S. Setty at the center, our Managing Director, Corporate Banking and Subsidiaries, Shri Ashwini Kumar Tiwari, our Managing Director, Retail Business and Operations, Shri Vinay M. Tonse, our Managing Director, Risk Compliance and SARG, Shri Rana Ashutosh Kumar Singh, our Managing Director, International Banking, Global Markets and Technology, Shri Ram Mohan Rao Amara, our Deputy Managing Director, Finance, Srimati Saloni Narayan, our Deputy Managing Directors heading various verticals and Managing Directors of our subsidiaries are seated in the front rows of this hall. We are also joined by Chief General Managers of different verticals and business groups. To carry forward the proceedings, I request our Chairman, Sir, to give a brief summary of the bank's financial year 2025 performance and the strategic initiatives undertaken. We shall thereafter straightaway go to questions and answer session. However, before I hand over to the Chairman, Sir, I would like to read out the safe harbor statement. Certain statements in today's presentation may be forward-looking statements. These statements are based on management's current expectations and are subject to uncertainty and changes in circumstances. Actual outcomes may differ materially from those included in these statements due to a variety of factors. Thank you. Now I would request Chairman, Sir, to make his opening remarks. Chairman, Sir, please.
So good evening, ladies and gentlemen. We thank you all for taking some time out to join this analyst meet, post-announcement of FY25 results of the bank. The financial results for FY25 highlight continuity, consistency, profitability, and SBI's significant long-term strengths. At the outset, I would like to thank all of our stakeholders for their support and helping us in creating sustainable value, not only for the bank, but also for the economy as a whole. Over the years, SBI has remained focused on strengthening the key components that contribute to this sustainable value. We have prioritized our liability franchise, refined our processes, continued to improve our underwriting standards, and aim to deliver value to all stakeholders while positioning ourselves as a reliable financial services brand. I will first start with a brief description of the present global and domestic economic scenario and then discuss bank's performance. Escalation of trade and tariff tensions and the resultant financial market volatility have raised concerns regarding the weakening of global growth in the near term. As per IMF, the estimated global growth is projected to drop to 2.8% in 2025 and 3% in 2026, much below the historical, that is 2000 to 2019 average of 3.7%. As per the WTO, world merchandise trade volumes could expand marginally by around 1.7% in 2025. The dampening global economic outlook could impact India's economic growth through weaker external demand, even though the domestic growth engines, consumption and investment, are relatively less susceptible to external headwinds. Prospects for the farm sector have been boosted by the forecast of an above normal southwest monsoon for 2025, which could augment farm incomes and keep food prices under check. Given the exacerbated uncertainties due to recent trade tariffs, RBI has reduced its real GDP growth projection for FY26 by 20 basis points to 6.3% in the April policy. Separately, India's CPI headline inflation has now significantly moderated, and we believe average CPI headline forecast for FY26 could stay below 4% now. During FY25, ASCB's credit growth declined to 11%, which was 20% last year, and deposits to 10.3%, which was 13.5% last year. Term deposit growth continued to outpace growth in savings deposits. Consequently, the share of term deposits in total deposits rose to about 62%. CASA declined to below 40%. Asset quality of SCBs improved further, with their GNPA ratios declining to 14-year low of 2.4% in December 2024. CRAR stood at 16.4% in December, which was much higher than the regulatory minimum ratio. RBI has deployed a strategic mix of interventions, including open market operations, daily variable rate repo auctions, and dollar-rupee buy-sell swap auctions. These proactive measures have helped stabilize market liquidity conditions, ensuring financial resilience in an unpredictable global environment. Coming to SBI, once again, the results for FY25 demonstrate the bank's ability to operate profitably at scale due to our substantial long-term strengths. These advantages stem from our institutionalized framework, which is guided by structured processes and a commitment to fairness for all stakeholders. The net profit for the year was 70,901 crore, up 16.08% year-on-year. At the end of the year, our whole bank credit growth was 12% year-on-year, with domestic credit growth at 11.56%. Deposit growth was 9.48% year-on-year, while the CD ratio domestic was 69.71%. We maintained stellar asset quality with slippage ratio of 0.55%. Retail personal slippage ratio was at 0.48% and credit costs at 0.38%. PCR was at 74.42%. Some details about these numbers. The total deposits have grown by 9.48% to 53.82 trillion. As I mentioned, term deposits have witnessed robust growth. They have grown by 11.48% year-on-year. Our current account deposits have grown by 27% year-on-year, and CASA deposits have grown overall by 6.34%. And CASA ratio was close to 40%. Importantly, the current account growth has continued to remain strong for the bank during the year, despite competitive market environment. The credit growth continues to be good across all segments. Our domestic advances have grown by 11.56% year-on-year, driven by 16.86% growth in SME, 14.29% in agriculture, 9% in corporate, and 11.4% in retail personal segments. Our foreign offices advances have grown by 14.84% year-on-year. The domestic credit deposit ratio is 69.71%, indicating sufficient headroom to address future growth requirements of the economy. The bank continues to demonstrate industry-leading asset quality at this scale. The slippage ratio for FY25, as I mentioned earlier, was 0.55%, while the credit cost stood at 0.38%. Net NPA improved by 10 basis points. We have a well-provided net and NPA book with PCR at 74%. The asset quality of the bank has continued to remain strong over the last 5 years, which demonstrates the quality of our loan portfolio, the robustness of our underwriting processes, effective collection efficiency, and the leadership of the bank across business lines. Our capital adequacy ratio is at 14.25%, and the CET1 ratio is at 10.81%, and are well above the regulatory requirements. Based on the current profitability and growth profile of the bank, we believe we have sufficient headroom to take care of business growth requirements. I'm glad to share the progress we have made in digital banking, which is an ongoing journey. More than 8.77 crore customers have been registered on the YONO, with 64% of regular savings bank account opened through YONO technology in FY25. Our subsidiaries are consistently performing well and continue to create significant value for all the stakeholders. We will continue to nurture these subsidiaries and maintain leadership position in the respective businesses. We are glad to advise that the bank continues to report ROA and ROE greater than 1% and 19% respectively at the end of FY25. A key point regarding these metrics is our operation at a substantial scale. We reported total assets worth 66.7 lakh crore, total advances at 42.2 lakh crore, and total deposits amounting to 53 lakh crore. When we mention scale, it indicates the bank's extensive investment in workforce, training, procedures, and compliance to maintain this level. Sustaining our growth rates implies that our bank's infrastructure and personnel are equipped to support continued growth at this magnitude. SBI continues to be the leader in all the risk-adjusted profitable lending and liability pools in India. Consequently, SBI's ROA above 1% is derived from the scalable fundamentals of banking, a stable NIM, controlled operating expenses, and maintaining credit quality. While we are happy about the outcomes in FY25, we are also mindful of areas for further improvement and also challenges emerging from various developments taking place across the globe which may impact Indian economy. On the liabilities side, we continue to focus on increasing our share in current account while maintaining our leadership position in savings deposits by further strengthening our customer service and branch network. Although the bank's cost base is substantial, it highlights our commitment to compliance and efficient operations. We intend to reduce our cost-to-income ratio by concentrating on increasing income. The bank's ROE profile is currently higher than its credit growth, implying that CET1 accrual in the future. From this strong position, our goal is to consistently achieve a ROE over 15% through the business cycles. The board has granted approval to raise equity capital up to 25,000 crores, with the authorization being valid for a period of 12 months. This is an enabling provision resolution. Although we are open to capital raising, such plans will be contingent upon the business needs and market conditions. Wrapping up my initial comments, I express my gratitude for your ongoing support to the bank. As the bank advances its objectives, it also plays a role in driving the progress and economic development of the surrounding ecosystem. We are dedicated to upholding your confidence in us by delivering superior, sustainable returns over the long run. My team and I are now open to taking your questions. Thank you very much.
Thank you, Chairman, sir. We now invite questions from the audience. For the benefit of all, we request you to kindly mention your name and company before asking the questions. To accommodate all the questions, we request you to restrict your questions to maximum 2 at a time. Also, kindly restrict your questions to the financial results only and no questions be asked about specific accounts, please. In case you have additional questions, the same can be asked at the end. We now proceed with the question and answer session, please.
Yeah, I am Ashok Ajmera. Sir, compliments to you, sir. In one of the recent meeting, I had said that our operating profit, we are capable of crossing 1 lakh crore, 1,10,000 now. Exactly that same figure I said, and you have achieved it. Compliments for that. Phenomenal numbers, good growth, in spite of little difficult time in the both deposit side and as well as credit side. Having said that, sir, I have got a couple of questions, some observations and some data points. One is that, sir, on the credit growth, like we have been maintaining last year that our target was 15-16%, and in I think a quarter back, I had raised this point that we have achieved only 8%, I think till December, 8.2 or something. How are we going to achieve it? And our confidence was that yes, we have got a strong pipeline and definitely we will try and achieve the given targets. But finally it came down to 12 point something. So on that, I mean, what has gone wrong just in 2-3 months that as against our targeted numbers, which was very good, encouraging, and good pipeline. In spite of that also, we couldn't achieve that number. So that is one. My second question is, sir, that all the TV channels are streaming that net profit of State Bank is down by 10%. Now they are just looking at Q4/24 of 20,698 crores and now 18,643 crores. If you look at it, the operating profit has gone up by almost 9%. So, but because of the higher provisioning in this quarter, this net profit, and they got the chance to say that SBI profit has gone down. Could we not have used some of that buffer provision, which we have got more than 30,300 or 500 crores, something out of that? And what was the need of almost about this 6,000 crore of provision in this quarter itself, which has given the opportunity for others to say that the profits are down, though it is not actually in fact. So this is the second of my some observation and your response on that. Thirdly, sir, if you look at the segment-wise results, there is a very deep variation. There is a strong variation in that. In segment numbers, the treasury numbers are haywire from 891 crore to few thousand crores, and wholesale banking, retail banking, the numbers have gone down by few thousand crores. So is there any change in, because segment also gives some impression, proper this thing that how is the bank is moving in which direction and under which segment. So if you look at it, there are quite large variations in that. So on that also, if you can throw some light on that, that is there a change in the method of calculation? And lastly, having you only has said that now another 50 bips point reduction may come. Some people are saying even 75 bips, and we have got a strong investment book. So do we expect huge bumper profits on the treasury account this year in FY26, which may take up our bottom line also to a great extent? What do you say? I mean, what color you would give to our treasury operations, both in the trading profit as well as the profit because of the mark to market, part of which comes to the profit, but AFS goes to the reserve. But still, what we expect into FY26 because of the rate cuts?
Thank you, Ajmera Saab, for the compliments and also the critical questions which you have raised. Yes, we did given a guidance last year. Not guidance, I think we have expected credit growth to be 14 to 16%. In the Q2 guidance, I have said this, and in Q3, I moderated that to the lower end of 14 to 16%. So there are, obviously we expected the year to close at 14%. If you see, most of the segments you can see on the screen, we have done, Acha, you are not able to see. I think in the presentation it is shown, yes. Slide 16, which shows that in many segments we have done well except in the corporate. Corporate is a bulky and chunky credit, and we have had an unusual prepayments in that segment. So while we have had a good pipeline, which I mentioned earlier also, even now we have around 3.4 lakh crore pipeline in the corporate side, the unanticipated prepayments definitely had impacted us. It is nothing to do with any of the segments not doing well. Many of the large central PSUs have utilized their equity funding to deleverage, and that we could not cover in the short tenure of 1 quarter. So that is the major reason. Otherwise, we still have the visibility on the corporate side, and that is the reason while we are not saying that it would be 14 to 16%, but 12 to 13% is quite possible, while the industry is growing less than 12%. This is on the credit growth side. On the net profit, I think, I mean, the numbers have to be understood by everyone. But our idea is, our focus is always to strengthen our balance sheet and also create a consistency in our performance. It's not about one quarter we try to ensure, but our preference is that if any costs are visualized, let us take them upfront. If you have seen, it is not only this time. Last year, 7,000 crores of pension provision we have taken in one go. We could have taken it in 4 quarters. I think that was permitted. So front-loading the costs has always been our strategy. And you're right. I think the ideal way of looking at it is the 12 months performance on an aggregate basis. And in many parameters, we have done extremely well, either on asset quality, in terms of ROE guidance, we still stuck to it. So the PAT has been, I think, has not been our, we didn't want to show that we can make the similar profit what we have made when we know for sure these costs are likely to happen. So some front loading of provisions have happened definitely. That has resulted in this. Yields moderation in treasury yields definitely would help the markets to perform better, and I think our treasury will do. While we are not willing to give any guidance on this, Ajmera Saab, we will believe that with the rate cut cycle kicking in, the yields will definitely moderate, providing an opportunity for us both on the MTM side as well as on the trading profit. So, but we will be a little more objective in terms of any guidance on the treasury side. Thank you. You asked something about segment-wise.
Yeah, because you see in treasury operations income from 843 crores to 8,891 crores. Corporate, okay, 74,284, but retail banking from 17,311 crore to 9,325 crore. So either we remove this, giving it, segment-wise numbers only, if they are not relevant.
Yeah. Just have a
or we do some working which is consistent.
We will ensure that.
Hello.
May not be in the slide. You're talking about from the balance sheet side? Or?
Yeah, segment results. And the
you're
results.
Talking about segment results, just have a look at it.
No, it's okay. I mean, if it is.
Good evening, sir. Yeah, good evening.
We'll have a look, Ajmera sir.
Yeah, please go.
All right. Okay. Thank you. Thank you, sir.
Sorry. So, sir, I had a couple of questions. Firstly, on the provisioning, if you see the breakdown of provisions, then there's an other provision of 16 billion or so. So, what is that about? Because it looks too big for that line item. So maybe there's some one-off there. That's my first question. And then on asset quality, so when I go through your movement of NPLs, there are some banks that have seen recovery from a very big account, right? And it's visible in their recovery line. So maybe it was written off for you, I don't know. But we don't see any recovery from the movement of NPLs of a large account. And that large account, the lenders are public, so you're one of the largest lenders there. So it's not a recovery, it is transferred to NARCL. So I'm talking about that account. Where would that have been booked? Because other banks have disclosed where it's booked and, roughly how much has been booked from there and where. So that's my second question.
You can answer on the second question. The first question.
And my third question is in employee expenses. This time round, I'm not talking about the pension provisions. I'm not talking about the provisioning or benefit part. But in employee expenses, the actual wage cost also looks higher sequentially this time. So how do we budget or how do we forecast wage costs for next year? Year on year, of course, for the full year, it's 6% growth. But just in the fourth quarter, the wage cost. So those are my questions.
No, let me first answer the wage cost. I think Q4 we take a lot of provisions. The PLI and many things which are added to the staff expenses, which are not in the earlier quarters. It will appear only in the fourth quarter.
Got it. So 6% growth is next year also,
That's all. And on the account which you mentioned, though we don't talk about specific account, but I think the accounting can be mentioned by
Yes, sir.
Ashutosh.
So without naming the account, so the account you mentioned, I think everybody knows this. So roughly 3,300 was the component we got, and 500 plus roughly went to the NP reduction. You can see it will come in the recovery piece. Remaining 85% essentially is the treasury income, SR, RBI circular which came on 29. So somewhere in the treasury side.
Sorry.
Provision.
So,
So 500 crore roughly. The 15% will come into NPA reduction. Recovery, you can see that number is in the NPA reduction.
okay.
Remaining will be on the SR revaluation, which circular came in the last week of March. That will go in the treasury side.
On the other income side.
Yes.
And has anything been booked into the NII? No, na? From this net interest income? No,
No,
na?
500 crore will go into, not NNI, it will go into the NPA
Provision.
reduction.
Got it.
Because it was a fully provided account.
Yes.
So it will impact the provisions, and the SRs we used to hold at 1 rupee. So subsequently on 29th March, the RBI has given a clarification that if you have SRs which are guaranteed by the government guarantee, I mean backed by the government guarantee, we can revalue the SR. So you see in your global market, I mean our treasury profits, the revaluation profit also is shown there. Some of the recovery related to what your account you are talking about also is appearing there.
Got it. And how much would that be, ballpark?
We will give you that.
Okay.
And capex cycle. Now, which are the countries where the foreign branches growth is higher than domestic growth? Because we have a widest network of foreign branches operation. If you can highlight that, and also the outlook in the year ahead, because there is a transformation in the economy, on foreign economy particularly. Second is our valuations. We have often talked about valuation, and of course we are among the very, very undervalued bank, and compared to the run-up in the bank Nifty at the highest and others are going much higher, we deserve maybe a valuation of 1,200 rupees, if not 1,000 rupees immediately, based on operating profit and the numbers. Now one clarification, most of the analysts and the databases, they look at valuation basically not in terms of P/E ratio, but in terms of price to book, right? Bank. Now when we look at our slide here, slide number 10, the valuation per book value per share and the book value per share in money control, which claims to be among the top 10 capital market websites in the world in terms of unique visitors and viewers, there's a big discrepancy, and we feel money control is far, number is correct. They talk about price to book of 1.57, which shows historic book value based on last year's. Today we are 2. Of course, it needs to be updated with the current one. I would like to know how you calculate, because when people compare all the banks, they go for money control book value per share. We can just see from the mobile, on the way itself I was reading it and seeing it just for chance. How can the book value be below 400 for FY24? So I would like you to clarify here and now, because bank analysts will just prepare the reports today evening and shoot it off, or maybe tomorrow morning, and I wonder how different ones will calculate, and they need not take from this slide. It's very, very important. Next is, we mentioned about this resolution for 30,000 crores. It is, wonder it is enabling, or all the banks now are raising money, huge money is coming, private banks and public sector banks, almost all public sector banks are raising money. Even the private ones, they are going for accelerated raising of QIPs and all. So what is the thought process on it? Are we going to raise money in equity seriously, because we don't require as per our capital adequacy, and often this has an impact on valuations also, and it should be at the right price. So your thought process, it's only enabling, or we are looking at it seriously, and of course the bank, what steps the bank will take to ensure it's at the right valuation. And with this, all the best. I hope, particularly as some point was discussed, this year, what is coming now, comes often, we say once in 10 years, treasury income, there'll be a lot of opportunities for a treasury team, and I hope they are agile as usual, and to see that we will break records in terms of net profit also. I wonder if we'll cross 1 lakh crore net profits, exceptionally for contribution by the treasury team. Thanks, and wish you all the best for the coming year. Look forward to the detailed reply to the question which you always do as usual. Thanks. Thank you very much. And my name is Manoj Alamchandani. Yeah, of course I know. Thank you. So, 4 questions, 3 questions and 1 observation. Of course, treasury gains, we hope that treasury continues to perform well. On the foreign branches, I request Mr. Mohan to respond on your question. I will supplement after his response. Similarly, price to book value, I request our team who is sitting in the audience to clarify that position. I'll start with my response to this resolution related to, it's not 30,000 crores, it's 25,000 crores, enabling resolution for equity raising. This resolution, of course, as you notice, that every year we take this, and our effort is to balance our growth requirement and also the need for augmenting the CET1 capital. You're right, today we don't need growth capital. We mentioned that with 14.2% capital adequacy, we have enough firepower to cover 8 lakh credit growth. So we don't need immediately in terms of the CRAR requirement for credit growth. But we still feel that if there is an opportunity to raise the equity capital, we will definitely.
Absolutely. But we will look for an opportune moment. And we always in the beginning of the year, we take enabling resolution so that we have an ample time to plan our equity raising if needed. On the foreign offices, Ram, you can respond.
On the IBG side, I think your observation is correct. We grew at a faster clip. Traditionally, we have the ability to play a complementary role to domestic. So whenever we feel like a domestic growth is slightly lower, we can always ramp up the IBG growth or the international banking growth. Because we use the 3 levers evenly, like we have exposures to trade finance, we have exposure to the local corporates, whether in US or UK, etc. Well-rated corporates, most of them are listed entities, and their debt is also available in the market. We can always pick up. And of course, we also cater to the larger Indian companies which want to raise ECBs. In fact, if you see, like well, traditionally, all the 3 components are equally balanced, 33%, 34%. We had a slight uptick in India-linked loans, where second half of last year we have seen a higher demand from the Indian corporates for raising ECBs because of the cost arbitrage. Even on a fully hedged basis, they their cost was slight better rated companies, they had a cost advantage as compared to rupee lending. So this is very, I mean, we are always look at the opportunity. Whenever there is a need, we can ramp up, or whenever we don't need, we can ramp down. That is the ability of the IBG portfolio.
Yeah. So in terms of the local credit, what do you see here? It is predominantly coming from the markets in US and a little bit on Bahrain. Bahrain, of course, is not local credit, but across the UAE and other jurisdictions. But local credit is the India related is essentially ECB, external commercial borrowings. We park those assets in the branches where the advantage of cost of funds is there. We are also extensively using the GIFT City now because of the tax benefits, as well as GIFT City's ability to raise resources also has improved. So predominantly the local loans are in the US and ECBs are in the GIFT City, Hong Kong and DIFC Dubai. These are the jurisdictions where we park the ECBs. Anything else we left out?
Sir,
Book value is most important.
Price to book value, yes. Yeah.
And the correction.
So, how we have calculated is the net, first of all, it is for standalone banking business. And the net worth divided by number of shares, that's how we calculate. And the net worth is 3,89,071 and the number of shares is 892.46. That is how we have arrived at 435.95. Also, this is also adjusted for the revaluation reserves. That is the methodology that we have adopted.
Can we mention standalone and Concall and also see how money control does it? Because the customer or the viewer, stakeholder looks at this databases like money control. There are many others which we are not mentioning.
But this result is for SBI.
True, I know.
Concall is only on the last page.
Yes.
The rest is all about SBI.
Yes. So that book value is not there. I calculated it myself, which was much higher.
Yeah, of course. When we add that,
and even the money control needs to be updated. So when we take a
please engage with
comparative
them.
one,
we can do that.
We'll engage with them. Yeah, thank you.
yeah, he has even seen.
Hi, sir.
And this is a large quarter.
Hi, sir. This
Can
is
you pass on the mic to him?
Nitin Agrawal here from Motilal.
Yeah, Nitin.
So I have a few questions. One is again on the OPEX part. If you look at the overheads also this quarter, we talked about the staff costs, but even the overheads, if you look at the miscellaneous number, that has more than doubled YOY. So anything specific that has caused this increase? And related to this, now that the bond yields have come off, do you think that there is a risk on the pension provisioning that we may need to make to beef up the plan assets?
So on the overheads, see there are 3 performance-linked payouts which we make to the staff. The primary performance-linked initiative is, the incentive is the industry agreed upon incentive. That is 15 days pay once we reach certain levels of operating profit. So that is generally shown in the staff expenses. There are 2 other PLIs. One is where 1% of our profit we allocate to the performance-linked incentive based on the grade related, in the sense AAA, AA and all these things. That also is shown in the staff expenses. The third element which has come now from this year would be a PLI scheme introduced from the scale 4 and above, chief manager and above, which is not 15 days space as agreed on industry basis. It is specific to the chief manager and above grade. That PLI is payable on approval of the government. That expenditure we have shown under the overheads. It could have been shown on the staff provisions, but since it is not to be booked, and we have shown, I think, please correct me if I'm, yeah. So that is also appearing in the overheads, which is showing the jump in the overheads. Otherwise, this element of PLI we could have taken in the first quarter also. But since we know broadly that what could be the expenditure, and our assessment shows that the bank is qualifying for the PLI, even as per the Government of India scheme. That is how the overheads have got elevated.
Right. Okay. And second question, sir, is on the Bhushan Power and Steel. Now, in light of the Supreme Court judgment, how are we looking at the impact on the banks and what is the impact on SBI from that? Any color around that will be helpful, sir.
Nitin, you know our stance. We don't comment on the individual accounts. So I restrain in terms of the impact. But I can tell you that we are studying the order. Obviously, the counsels for the lenders and counsels for the company, counsels for the RP, we all will sit together and see the impact of this order and what could be the potential options available to us. Beyond that, we will not be able to comment on this. Thank you.
Okay, sure, sir. And the third question, sir, is on the NARCL sale, because now that the RBI has allowed the SR provisioning right back, and we have availed some of that in this quarter. So are we looking at a more higher number of sale this year, and what could be the potential right back that we may see in FY26?
Our transfer to NARCL was never guided by what is happening on the provisions. I think RBI clarification is more in terms of the differentiated approach towards the SRs guaranteed by the Government of India. Otherwise, any SRs which we get where asset is fully provided, we normally carry that SRs at the rupee, 1 rupee value. But here the situation was different because SRs are guaranteed by Government of India, and RBI has taken a decision that if it is backed by government guarantee, you can have a differentiated approach, and if you are showing at 1 rupee value, please you have an option of revaluing those SRs. So that is how the revaluation has happened, and you can see that gains also in the treasury side. So I don't think either it will depress or it will increase the movement to the NARCL. The transfer to the NARCL so far have been significant. It is more than 1.06 lakh? 1,50,000 crores worth loans have been transferred to NARCL already. So which means that this enabling provision was not there, despite that the transfers have happened. It will be purely based on what is the right strategy for resolving an account. If we think that aggregating the bad debt into NARCL for a better resolution, I think the asset will move there.
Right, sir. And sir, lastly, on the ROA, wherein you have, in the earlier quarters, mentioned that the SBI will look to maintain 1% plus ROA. Now that the RBI is cutting rates and there is a possibility of more repo rate cuts which may impact margins, how confident do we feel to maintain 1% plus ROA? Any risk do you see emerging on that front?
I think we still will be able to maintain 1% ROA. How quickly the further rate cuts will happen will determine. Correct. So MCLR readjustment will happen only when the incremental cost of deposits will come down. So we will ensure that the readjustment of interest rates on the deposits are aligned at least broadly with the repo rate card so that the margin protection is there. But I am unable to tell you when will it happen, how deep will be the rate cuts. So broadly on annual basis, we may have some quarters where there will be much more pressure on the NIMs and impact on the ROA. But broadly, we are sticking to our guidance on 1%.
Sure, sir. Thank you so much. And wish you all the best.
Hi, sir. This is Bhavik from Ingrid Capital. Sir, 3 questions. First on savings rate, deposit rate. So we saw large private banks cut 25 basis point. So what would be our stance in the immediate near term, and maybe if RBI were to cut repo rates by 100 basis point, then would we still maintain the 25 basis point delta versus large private banks in our SAR rate cuts? Second question, sir, we saw very good recovery from run-off income this year. It was 80 billion, last year was 70 billion odd. So as in how confident are we that it will sustain for the next year and onwards, and how many lumpy accounts are left in our recovery from TWO pool? Third question, sir, staff cost was on a YOY basis was very good this year, partly because we had taken like stepped up provision last year on wage hike cycle, so on and so forth. Next year, AS15 provisioning will also come. So can we expect like mid-teens growth in staff costs next year, or that will be too far a reach? So yeah, I'll stop there, sir.
So on the savings bank interest rate, there's no plan to cut any further on the savings bank rate cut. I think we'll maintain at this rate, while the ALCO will take a call on that. But broadly, I think we believe that the rate is stabilized at this level. The other banks have had higher rate, so they had the room to cut that savings bank. But as I mentioned, there will be some readjustment on the fixed deposit going forward. Recovery in return of accounts, we don't have any chunky accounts where the recoveries are coming from. It is broadly coming from the smaller accounts. And we have strengthened our recovery processes. In fact, we brought back our stressed assets management regional offices. We used to have SAMROs, to monitor the low value recoveries. And when the large scale NPS had to be resolved, we have slightly reduced the focus on the regional offices. We have actually removed the regional offices. In the last 2 years, we brought back the regional offices. So there is a renewed focus in terms of the small value recoveries. That is what you are seeing. Much of this 2,000 run rate per quarter is essentially coming from the retail loans and small value loans, both in the stressed asset group as well as in the retail banking group. So hopefully, I think that run rate is expected to continue. Staff costs, any input from Surani? Staff costs.
So the staff expense has gone down from 71,237 to 64,352. Basically, the provisions for employees has come down by 36.86%, which is because of the provisions that we made last year for the bilateral wage settlement. And coming to salaries, on a YOY basis, the salary has increased just by 5%, and that too, the PLI has been taken into consideration. Despite that, the increase is just 5.79%. Provision for pension also came down because of the MTM gains we made on account of the yield movement. Gratuity has gone up by 40%, but the amount is very minuscule. Other than that, I think no other numbers to call out. So from 25,860 this year, it has come to 16,301 as regards salary is concerned.
Okay. Thank you, ma'am. So last two questions. First, so we are still paying higher in the lower, shorter duration of buckets in the term deposits. So when would we kind of realign with the other banks? And now the system liquidity is good. So why, as in, are we still paying higher in the shorter tenure buckets? Second, sir, our CET1 ratio 10.8%. So out of that, as in, how much would be AFS reserve? So in the revised investment guidelines, MTM gains on AFS is part of CET1. So that's it, sir. And thank you so much, sir, for giving the opportunity.
So the interest rate will be relooked in the coming ALCO this month. So we will definitely look at all the tenors. You're right. I think most of the short tenor higher rates are generally given in the last quarter, just to ensure that the liquidity is available. But we will, and also when the interest rates are coming down, none of us want to lock in at a long tenor interest rates. But we will review all of them in the ALCO. And what is the other one?
AFS reserves, sir?
Yeah, AFS
Can
reserve.
I respond? It is 6,600 crores.
Yeah. Hi, sir. This is Jay Mundra from ICICI Securities. Sir, question on your express credit growth, right? So the YOY growth has come down to almost less than 1%. The GNPA number that you show in that book is actually, it has come down from 1.11 to 1.07%. So how would you look at the growth in this book? I think 1 or 2 quarters back we had said that we are looking for maybe early double-digit kind of a growth there. How do you look at that book growth?
No, we are definitely seeing some uptick on the express credit. In fact, Q4 we've had a net growth of 5,000 crores, 5,600. This growth rate on the year-on-year looks smaller because the earlier quarters have been not so good on the express credit. There are two reasons. One is that we, as I mentioned in the last quarter also, we completely revamped the whole process of extending the express credit. We also looked at some of the lower segments of customers, though they're salaried class, the leverage is going up there. But we are confident that the growth will come back for two reasons. One is the NMI, EMI profile of many of these lower end customers in the salaried class would definitely improve with a revised tax structure. So hopefully their credit profile will improve. And some of them whom we are either not lending or they are not borrowing will come back to the express credit. And on the asset quality front, asset quality in the express credit has never been an issue. I think it's just movement of a few basis points. Otherwise, it is holding up very well. It is something what we are now have another potential area is that among the corporate salary package customers, the new customer acquisition in the last financial year was 6.5 lakh customers we have acquired under the corporate salary package. And as you know, most of the express credit is extended to corporate salary package customers who have salary accounts with us. So this 6.5 lakh new customer addition to the CSP also gives some amount of pipeline for the express credit.
Right. And sir, lastly on domestic NIMs, right? So if I look at this quarter the NIMs have been stable. While I can see that the cost of deposit is still going up, at least that is what is being shown in the presentation. But on a full year basis, sir, if I look at the beginning of the rate cycle FY22, from there we have lost around 13-14 basis points margin on the domestic book. Right? So now the rate cuts, I think the first rate cut was in the early Feb, and only let's say half of the quarter impact would have been there in fourth quarter. Now going ahead, remaining half will come, and then the second rate cut that was announced, that will come. How do you look at the overall NIM trajectory, sir?
Yeah. No, first of all, I think there definitely will be pressure on the NIM. There is no denial of the fact. How much pressure will be there? The pressure will be relatively less on us because, as we mentioned, that our repo-linked loans are only 29%. Our book either is predominantly MCLR linked or fixed rate loans. Is almost 70% of that is MCLR plus fixed rate loans, 50%, and which means that the impact of any further rate cuts would take some time for us. But as I mentioned, there will be an imperative need to readjust the rates on the deposits. Obviously, the monetary transmission and MCLR impact will not be visible unless we readjust that. So the effort would be to protect the NIM at 3% level. But there would be some quarters where we will have some pressure on the NIM. I'm not able to quantify immediately because we don't know how the rate cycle, while broadly we believe that there would be another 50 basis point rate cut, how quickly and how much is unknown at this point of time. But the fact that the NIMs will be under pressure is something which we recognize, and we'll see what kind of effort can be made in terms of adjusting the rates both on the deposits and the loans.
So, sir, just lastly, if the NIMs are under pressure, credit costs remain very excellent, right? From 38 basis point full year, they are as good as standard assets provisioning only, right? So, what will sort of a cushion ROA at around 1%?
Treasury gains. So, Ajmera Sahab said that Treasury should perform well. No, I'm not looking at the Treasury has to heavy lift, but I think the our focus is always on the core activities, how efficiently we run the core activities. But treasury is also a core activity for us because we run the largest treasury in the country. So obviously we have the potentials as well as the downside risk on the treasury, and we will have to play on that.
Sure. Thank you, sir.
Yep. Due to paucity of time, we will now take up a few questions coming in through the online webcast, which will be addressed by the chairman, sir.
Yeah, for other questions, we are available offline. You can always reach out. So the online question, Abhishek Kumar Jain, what would impact of repo rate cut in NIM? I think I have broadly explained in detail, so I'm not going to repeat on this. Mayur from Wealth Managers, what is the outlook on cost to income? When will we start seeing benefits of operating leverage plus digitization? Year after year, cost to income continue to raise. I think for a change, we have shown better number on the cost to income ratio. Yes, I do agree that we have obviously have to take the leverage of digitalization which has happened. Just for data point, our alternate channels are performing extremely well today. 98% of the transactions are conducted through the alternate channels. Some channels are expensive, like ATM and customer service points, but digital channels are cheaper. So we are trying to see how the digital adoption will progress and bring the cost efficiencies. Our focus would be mainly on how do we increase the income, while the cost rigidities, particularly on the employee side, will remain. Staff expenses also moderated, as we mentioned here, and pension provisions are also decreased. But these are some of the costs which from time to time will get elevated. So our focus would be on increasing the operating income. So the guidance broadly is to keep it below 50 to 51% level. Puneet Shukla, what is the current status of bank customers as on date, where we stand in customer base? We have more than 52.33 crore customers as on March 25. Bunty Chawla from IDBI Capital, Express Credit segment has seen decline in credit growth. Outlook on the same, I mentioned. I think we have acquired a good number of CSP customers, providing a visibility on the Express Credit. And also we have seen a good growth in the Q4. So we hope to continue that. Kunal Shah, when do we expect to conclude equity fundraise and what would be the preferred route? Other provision reversal of 1600 crore, does this include any specific chunky corporate account provisioning? 3,900 crores and government guaranteed SR reflected in profit on revaluation of investments. Forex income appears very volatile and has almost doubled. What is the normalized level? See, I think I answered the first thing. What is the normalized level of this income is very difficult to predict because the Forex markets also play on the volatility. Forex income obviously was helped by the volatility in the market. Government guaranteed SR reflected in the profit, yes, 3,900 crores, but at the PAT level it is about 2,800 crores. Fundraise 25,000 crores. I told you that is an enabling provision what we have taken. We will see what is the appropriate time to access the market. Abhinav Gundluru, given the rapid evolution of AI technologies globally, can you share SBI's strategic roadmap for AI adoption, particularly in areas like credit risk assessment, fraud detection, etc., and whether SBI envision AI playing a role in operational efficiency and growth? We strongly believe that if SBI has a growth rate of 10 to 11% on the balance sheet basis, which means that SBI gets doubled. I think this is my favorite story. I keep telling everyone that SBI gets doubled every 6 to 7 years. And this cannot be handled. And we have doubled from 2018 to 2024 in our size. We were 30 lakh crores in 2018. We became 60 lakh crores in 24. And we have not doubled our branches, we have not doubled our head count, but we brought the efficiencies to the digitalization. And we strongly believe that the new age technologies like AI, we were the early adopters in banking sector in the predictive AI modeling. Our pre-approved personal loan, PAPL, was a big hit, which was based on the predictive AI. So we are also using the Gen AI and the new emerging technologies Broadly, initially we have used GenAI based chatbot for deceased claim settlement. This was one of the most irritating problem for the customers. When somebody dies in the family, how do you settle that account? And we have used the AI tools to expedite and simplify this process. We also have GenAI powered Ask SBI. This we thought that is a good use case to give the tool. This is a repository of all the information, circulars, SOPs, policies in one go, which is available to the employees. And the GenAI tools are deployed. We call it now Spark, where the employee not only searches for information, he is able to get a standard operating step-by-step procedures to handle a query. We are further fine-tuning this. I think the knowledge-based activities and fraud risk management, PRM tools are also being fine-tuned using the AI. I think a lot of use cases we are experimenting with hopefully will result in the productivity gains. Akshay Jain, can you explain the large sequential movement in miscellaneous non-interest income and miscellaneous expenses? Q-on-Q basis, miscellaneous income has increased by 80%, mainly due to increase in dividend income of 1,645 crores. Expenses has increased by 110%. Major item is, as I mentioned, grade PLI provision of 1,300 crores for scale 4 and above. This is as per the Government of India PLI scheme. Rohan Mandora, your cumulative yield and advances for domestic business has increased in Q4. As per slide 23, we wanted to understand where we have taken yield hikes, given that there was a repo cut. In quarter-on-quarter basis, 4 basis point increase in the yield advances is mainly an average advances level going up. There has been some uptick of benefit of the previous MCLR increases, which took some time for to gain that, and that has resulted in the 4 basis increase on the yield and advances. Provision for NPAs have been higher in Q4, as we mentioned. I think is broadly because of the aging provision. Fresh slippages provision is very modest. Kahul Koshi, what was the reason for large provisioning this quarter? I've already explained. Where is the government-backed SR provision reversal reflecting in P&L? The gross amount is getting reflected in the operating profit, 3,875 crores, and net profit increases 2,900 crores after adjustment of tax of 975 crores. Raktim, our net interest income margin squeezing because of raising deposit costs. How bank is thinking? I think I've spent considerable time in explaining how the NIMs will be protected. I hope you are able to follow that, and thank you very much for all of you.
Thank you, Chairman, sir. I trust all the questions.
Yeah, please.
Yeah, Nitin Gandhi here. Within the diversified loan portfolio, if I see other industry classification, which is almost 5.4 trillion, that has the highest growth of 22% as compared to any other industry. Something is unusual. Some color can you share on this other industry? 22% growth in other industries.
Other industries. Okay.
It's 5.4 trillion of the portfolio.
So a lot of things which are not classified here, they all get into that other industries, but it is mainly coming from like industries like data centers and all could not be put in anywhere.
Okay.
Doesn't fit in the real estate or so some of those items move in there. But it's a very diversified one. Maybe 5-6 major industries. Saloni, you can give later to him,
sure,
which constitutes other industries.
I'll take it offline.
Right.
And the second question is, can you share some thoughts on the sanction loan book? How is it behaving post-March? Current?
Sorry, come again.
Sanction corporate loan book. You said that towards March, central PSUs and everybody reduced. But now how are they behaving? What is your expected disbursement coming over the next 2-3 quarters, if you can share some thoughts on that?
So we have good visibility on the corporate side, 1.77 lakh crores, which is sanctioned but not disbursed. Much of that growth will come from that segment. So there's a visibility. We only hope that nobody again decides to deleverage and prepay the loans. But broadly, we are sticking to our 12% growth rate on the corporate side also.
Thank you.
You
All
want
the
to say
best.
anything?
I think one thing which Chairman explained in the last quarter, many of the central PSUs got a lot of money from government, and with the clear instructions to pay all the lenders, which happened in our case, very, very large accounts were prepaid. So that brought down the corporate book. Otherwise, till quarter 3, the growth rate was pretty good. And we are not seeing this happen now, because now the disbursements and the overall pipeline, as Chairman has already said, 3.4 trillion, out of which half of it is sanctioned already. So we should see consistent growth in this corporate book, including the project finance. We are not seeing any other behavior which was seen in the quarter 4 last year at this point of time.
Thank you.
Thank you. Thank you very much.
I trust all the questions have been addressed. We will be happy to respond to other questions in offline mode. Let me end the evening with thanking Chairman Sir, MD Sirs, DMD Madam, top management team, analysts, investors, ladies and gentlemen. We thank you all for taking time out of your schedule and joining us for this event. To round off this evening, we request you all present here to join us for high tea, which is arranged just outside this hall. Thank you. Thank you so much.